For more on what to expect from the Fed amid this banking crisis, we welcome in Sonia Meskin, head of U.S. macro at BNY Mellon Investment Management. Thank you so much for being here. Obviously, a lot to consider. As I mentioned, we just heard from the ECB. They've made their decision. They raised 0.5%, right, at their meeting. How do you think the Fed is going to play this between sort of challenges on all sides?
Very, very tough situation for the Fed. Remember, rates are in absolute terms high here in the US than they are in the Eurozone. The growth is also higher. I think, it used to be that their choice was tough enough between employment and inflation. And now it's between employment, financial stability, and inflation. So it's not an easy choice. I think that on the one hand, if we do get as a result of this, you guys mentioned before, small regional banks are still under pressure today. If what we get from this is a contraction in lending that leads to a contraction in U.S. growth, that will likely, at least to some extent, take care of the inflation problem for the Fed, but also likely at the risk of a recession. The data right now, we saw quite strong data for the CPI in February earlier this week. The data on the inflation front remains strong, but it's a question now how much of it is too backward looking. So I do think they go 25. Obviously, I think 50 basis points is not something that is seriously under consideration in this scenario. I do think they're more likely to raise rates than not, which will show that they've ring-fenced the problem on the financial stability front. But it really remains to be seen whether that's true or not.
It's not just banks that have to signal confidence to households, to businesses. It's also the Fed here still that is trying to move past its own credibility kind of crisis, if you will, coming off of 2021 and even into 2022. And so with that in mind, where do you expect the Fed's tenor to change as well, if at all?
Well, they used to say that they like to use the right tool for the right job, right? That's Bernanke's point. So use the different tools for financial stability than for monetary policy. That would be their ideal scenario. If they effectively ring-fence this problem, then the economy more broadly should continue to function well. And in fact, they would have increased liquidity with this new facility that they just rolled out. But that may not turn out to be true if some banks curtail their lending significantly, right at the time that the Fed is also conducting quantitative tightening. So they're also withdrawing liquidity from the market.
So that sounds like a risky proposition then in terms of indeed leading us into a recession.
Yes, I think the odds of a recession have increased.
By how much?
It's hard to quantify, and the situation remains very fluid. But, as you guys brought up earlier in the show, even if we don't see a recession today, I think that really doesn't take care of the inflation problem then. They continue to hike, and the non-linearities associated with higher rates only increase. So we're getting these banking problems, and rates are not even they're not even at 5%. Obviously, markets had priced in over 5% policy rate a week ago, which partially led to this. But imagine what we might get at 6%.
Yeah, Sonia, I want to ask you, we keep talking about the odds of recession, and we also have talked about how the job market sort of lags that, right? That the job market, at least on the surface, still looks relatively strong, even as we keep debating recession. When we talk about how severe the recession could be and that the odds are going up, what does that imply for the job market? Does it sort of shorten the lag at all? Does it mean that an eventual jobs downturn will be more severe? How should we think about that lag effect?
Yeah, I think you could think of it as both. It's one thing to look at areas like tech, which actually tend to not employ a large percentage of the U.S. population. It's something else to look at small and medium-sized enterprises who do rely quite a bit on regional banks. So if regional banks curtail lending to small and medium-sized enterprises, you could expect more job losses there. I also think that, of course, you could have a lag effect with the job losses themselves. So when unemployment goes up, typically doesn't just go up by 50 basis points. it goes up by more than that. And that is hard to monitor and arrest in real time. So I think both of the risks that you outlined are there.
All right, more to weigh on us here this morning. Sonia Meskin, thank you so much for your perspective. I appreciate it. Head of U.S. Macro at BNY Mellon Investment Management.